As always, Scott Carson, excited to be here with you today. Today's episode is kind of the part 3 in our 3-part process. We talked previously about how to find non-performing notes and different ways that we find assets. Previous episode, we talked about different ways to fund. Today's episode is all about the flip or the exit strategies. Now, whether you're in performing or non-performing notes, you got to understand these exit strategies. One of the biggest misconceptions is, especially people in the performing note space, like, oh, I'm just buying performing notes. I won't have to deal with any foreclosures, or I won't have to deal with any defaults. That's wrong. Every person that's in a note investing needs to understand their options, because if you don't think that your borrower will ever at any time default or fall behind in payments or go through a financial hiccup, you may only be dealing with a small fraction of deals. I know there's one investor out there, oh, I've never had a foreclosure because I've done cash for keys. That's great, and that's awesome, but it means you're probably being pretty picky about what you're buying, and you're not, you don't really have any type of real big buying platform. Because look, foreclosures happen, defaults happen, and they're going to happen more now than they have in the last couple of years. I mean, people are struggling to get by, so you need to know the different exit strategies that are available to you. And I'm not going to go too deep, and I'm not going to go into the nitty gritty of each exit strategy. We go more in depth in our 3-day virtual workshop, and I encourage you to check it out at notebuyingfordummies.com. Check it out. It's on sale right now. Host that class once a quarter. So if you missed the most recent one, guess what? Get signed up for the next one. You'll get the replays, the previous one you start learning now. But exit strategies are important because you got to know, how the heck are you going to make any money? And that's kind of what we'll talk about, how each strategy is phased and how you make money with each one. So let's just start from the beginning. And this is the first strategy that a lot of people come into the note space is not necessarily buying a note, but it's wholesaling a note. And yes, you can wholesale notes just like you do traditional property. And a wholesaling a note, what are you going to make? Well, it'll vary in what you make. It all depends on how good a deal you can negotiate in the front end. Now, you can wholesale performing notes, you can wholesale non-performing notes. It's more profitable on the non-performing side because you can get a bigger chunk in there, depending on how big a discount is. But with performing notes, the most you're probably going to see is probably a 1 point, maybe 1.5 point spread on a wholesale fee. All right, and that's on the funding amount. You get beyond that, you're really, unless it's a great discount in a performing note, you're eating most of the profit. So 1% is pretty normal. That's what we'll pay on a performing note if it makes sense. And we still have to see an 8% yield to us on our side on top of that fee. But putting under contract, flipping the contract, wholesaling is wholesaling. Just make sure you know what the heck you're doing. And a non-performing note, our wholesaling is going to be a whole lot bigger. I mean, maybe it's 3 points if it's a portfolio, maybe it's 2 points. You might be splitting that with 1 or 2 people, or it could be a flat 5,000, 500. I mean, I've had wholesaling fees from $500 to $100,000 before on an individual note deal. So just know what you do. You always want to make sure you leave meat on the bone, especially on the non-performing side. So anytime you start getting above 65% of value or UPB on a non-performing side, you're really going to narrow down. I've seen people like try to flip stuff with non-performing stuff at like 75% of the value of the property when there was no equity there, or very little equity, and that's just too high. You're just not leaving enough meat in the bone. So keep that in mind. Wholesaling, first strategy. You're not really a buyer. You're not really an investor. We've done a previous episode on why wholesaling. You're really not an investor. You're just a paper flipper. It's great to make some quick cash. You got to do some work, and you might as well just raise capital to take the deal down because you'll make more money. But wholesaling, it's kind of quick enough. You're not really buying anything. You just got to make sure that your buyer is going to fund the deal, because if you end up having your buyer flake on you, then you're caught holding the bag. You can burn a bridge. You don't want to do that. Okay. That's the first strategy for a lot of people in the note. But the second strategy is, once you buy a note, especially as non-performing, is just to reach out to the borrower and say, hey, what's going on? Let's try to get the borrower to reinstate the loan and start paying on time again. That's the greatest thing, is if you can get a borrower, especially buying a non-performing note that's occupied, and reaching out to the borrower in the first 30 to 45 days, either yourself or through a third-party service, which is I would recommend, is getting that borrower back on track. Now they're making monthly payments. Hopefully they're back on track. Maybe they're bringing a little bit extra to the table, some extra skin in the game to allow you to reinstate it. And that's great. That's cash flow. That's what we're looking for. We only wish borrowers got back on track in a timely fashion. Sometimes it's 60% of the time you usually get a borrower back on track if it's occupied. the other 30-40% is going to go happen one of the different ways. But that's the best way. Get it reperforming, no attorney fees, no rehab costs. You may not even have to pay taxes if the borrower can pay taxes if taxes are past due. But that's the great thing. You got somebody living in the property who wants to take care of it. Hey, bingo, bango. That's hitting the note lottery, I like to say. A reperformer, 12 months from now, of 12 on-time payments, that note's now reclassified as reperforming. It gives you a whole different extra strategy on the later routes, which we'll get to. But reperforming, your servicer is going to reach out and try to make right party contact. Part of your due diligence you want to do is make sure you have numbers or contact information either through skip tracing or through the servicing notes from the previous servicing company or the existing servicing company to make sure you can reach out. Now, why would a borrower start performing with you versus the existing seller or the bank? They just may not be financially savvy. We found that some servicing companies are just downright horrible in borrower outreach, where there's always an automated message. There's nobody they can talk to. And you're not dealing with the most financially savvy people out there. They need somebody to talk to, take a payment on the phone, how they send it in, or how to set up ACH. You just got to be able to talk to people, especially the lower the asset class, the more you've got to have somebody on the line there. And one of the greatest things that worked for us in getting people to reinstate was just to send a letter out a week after we close, say, hey, we want to keep it in your house. Your note's been sold. We've bought it. You're behind. Give us a phone call to get back on the right track, and let's work with you. Okay. And get them to reinstate. That's a great thing. Now, if they can't reinstate the loan, then you kind of go to plan B when it comes to the performing side. And this is offering up or seeing what they can qualify as far as a trial payment plan. First, that trial payment plan, you probably want it to be at least 6 to 12 months. I prefer 12 months for tax purposes, because then it's classified as a long-term capital gain until you modify it after 12 months. If somebody's bringing a big chunk to the table and they want to do a loan modification, I still going to want them to make payments on time for at least a minimum of 6 months. 6 payments on time. It may be a reduced payment, may be a normal payment plus some extra. That trial payment plan numbers can vary on what you see. And then after that trial payment period, then you modify the loan. And once you modify the loan, those new terms are fixed. You can't, if you modify a loan and the borrower misses a payment immediately, it goes non-performing, you can't go back to what the previous terms are. So if you've forgiven some balance or reduced interest rates or forgiven past due payments, those things are gone. You can't go back and recollect them. This is why we like to make sure that a borrower is making a trial payment plan for 12 months. After 12 months, okay, yeah, modify it. We'll do a lot of great things. Forgive some debt off it if the value's not there and go from there. But doing a trial payment plan to a loan modification is the biggest plan. If you get a borrower that wants to do a loan modification immediately, I say, look, if you haven't been paying on time for a while, let's do a trial payment plan, because I don't want to lose that ace in the hole, being able to go back and start the legal process for everything that they're owed, not just the new stuff once the loan modification goes through. Okay. Now you can do whatever you want, as in modifying terms or adjusting terms on a trial payment plan. Just get them making payments. That's the whole idea. Get them making payments and go from there. And of course, if they can't make the payments, then you got to go to plan C, which is one of these next strategies. And the next strategy I'm talking about is see if they have somebody that can come in and do a loan assumption. We as investors often hear me talk about subject to deals. Maybe they have somebody that can take over the loan subject to the existing terms, a friend, a family member, maybe another investor looking to buy in that area. I'm not opposed to a borrower letting somebody assume the loan. And yes, you can let the borrower assume. It used to be previously that all mortgages were assumable. Then I think after 85, the VA loan was the only thing that's assumable. Look, as long as I'm getting paid, I don't care whose name is on that check. As long as that check clears or that cash is still green or that wire comes through, I don't care if it comes from Johnny Smith, who's not related to Mrs. Smithers, who owns the house, or whoever my lender is. Don't care. Now, what I would like to know is the information and all the contact information for that person taking over the loan. I prefer to go ahead and have that borrower, that new borrower, or the person assuming the loan, to fill out some sort of financial document so that I know that they can actually afford that. Now, I'm not going to adjust the payments. It's going to stay as is. If they want to get a new loan, that's origination. Then they need to buy the property and go that route. That's a whole different strategy. If I'm doing a loan assumption or even a modification, I don't have to be Dodd-Frank compliant. I have to jump through an MLO process. You want to have your servicing company handle the paperwork for that. But I'm not originating a new loan with a loan assumption. If somebody wants a new loan, the new terms, interest rate, reduce that stuff. Well, guess what? Then you're buying the property on terms. You're gonna need to bring some money down for that. If I'm letting you just take it over, you're taking it over as is. Unless you're gonna bring some money to the table, then we'll go from there. Then I'm willing to modify the loan and then go from there. All right. But loan assumptions, they're still happening. We've let people assume the loans. And it's a powerful strategy that a lot of people forget about as an option. Do you have somebody, a family member, friend, whatever, who would like to take over your loan? If they can't make payments, they can't do a mod, they can't find somebody, don't have anybody, then what you want to do is look to potentially take the asset back. Look, Mr. and Mrs. Smith, I know you can't pay your payments on somebody. You can't pay, so you really can't stay. So let's do a deed in lieu. Let's do a deed in lieu of foreclosure. So if you're having a foreclosure on your record that's going to affect you for 7 years, you're just going to have late pays. Let's have you deed the property back to us. When you deed the property over to us, they deed the property over. We forgive the debt. They're walking away. We now own that property as an REO. In some places, it's called cash for keys. If you need to motivate the borrower to get up and move, and we've done cash for keys anywhere from like $500 to 10 grand. You know, it varies. The more they can leave it and clean, the more I'm willing to work with them. If they're going to leave it dirty, I'm not going to do it. They've got to sign that deed in lieu first, and then I may give them a week to get out. But I don't incentivize them with one check. It's got to be, okay, I'll give you $500 to sign this over, and I'll give you the remaining $1,500 if it's $2,000 cash for keys. $1,500 a week later, when you're, give the keys to my realtor, and the property's got to be swept out. It's got to be in clean place. If it's not going to be clean, I'm not going to give you. I'm just going to enforce it and go from there. But you got to make sure it's clean. And you want to make dang sure before you accept the deed in lieu that you've pulled title and make sure there's not a second mortgage or anything outstanding liens against the property that will appear into a first lien position should you release that first lien. Okay. Now, if there is a second on the property or a lien of some sort, then you would want to do a consent to judgment. This gives you the right as the lender to go in front of a judge and say, hey, judge, the borrower is consenting to a judgment. Let's go ahead and expedite the foreclosure to wrap up and get rid of the second. Now, if there is a second, I always will reach out to them first and offer them $1,500 to go away. If they won't play ball with that, that's fine. We'll go the foreclosure route. One thing to keep in mind if you're buying condos is that there may be HOA fees outstanding. Double check that, see what state you're in. You may be able to negotiate a safe harbor ruling when you only got to pay 6 or 12 months of the original HOA fee or a percentage of the original sales price. But that's an important thing. Instead of just accepting a deed, you don't want to get a consent to judgment so you can wipe out those HOA fees. Okay. Now, maybe the house is in good condition. Maybe it's in a hot market. Maybe you don't want to deal with taking the property back, having to market it, clean it up and fix it. Maybe it's in good shape. So maybe allow the borrower to do the next strategy. Let's do a short sale. Short sales are starting to creep back up here. Now, previously to this, when there was all this equity, you wouldn't have short sales. People would just, if they needed to get out of the house, they would just sell their property, list it on the MLS, hire a realtor and be done because they had this equity, they could sell the property. Now that equity has switched a little bit, started having negative equity again, or people don't have the money or the room in between what they owe and the property value of the house, maybe they're underwater a little bit, they don't have the money to pay the commissions or any slight repairs. So short sales are starting to make a rebound. In a short sale, this is where we accept to take a loss. So let's say our payoff is 220 grand. Let's say the property is only worth 200 grand. Well, that's $22,000 that the borrower doesn't have to come out of pocket. So we would allow them to list this property for sale. We would accept us taking a short, hoping that we could get 90 cents on the dollar. And one of the most important things as an investor, if you got a borrower that's going to do a short sale, make sure it's listed on the MLS. Make sure it's not with their best friend forever, BFF, who can drag out a short sale. Make sure it's with a non-related agent. Make sure the agent lists the property at 85% of value so that you get a multiple offer situation and get foot traffic. If they just list it for the full value, and based on our numbers I just gave you, let's say they come and list at 200. Well, if it says third-party approval required, you're not going to get a lot of foot traffic. People don't want to wait around 30, 60, 90 days for a short sale. They want to be able to get in a property immediately. So if you list it at 85% of value, that's going to give people some incentive to hang around to get a deal. And at 85%, you're probably going to get multiple offers, hopefully, which allows for you to work against them to bid that bid up. So maybe you only settle at 90, 95 cents of the dollar, you're taking a bigger loss, a lesser loss. I mean, hopefully if you're buying a a $225,000 note and a $200 of property, you've only paid like 100 to 120. That extra 25 grand above your 200,000, you're not going to see anyway. So you're not really taking a loss. It's more of a paper loss, and you could technically write that off if you got a good bookkeeper. So short sale's great. Have them list a property for sale. If you don't see any activity in the first 30 days, then I would cancel the short sale and then go back to doing a deed in lieu, cash receipt, keys, or consent to judgment on that aspect. But do not allow the borrower in this situation on a short sale to dictate showing times. No. If we're going to do a short sale and not come after you for anything that we're shorted on, we got to be able to show that property in a given time. You got to keep it clean. We don't expect you not to keep it crystal clean, but we got to keep it kind of clean. If you've got dogs, we got to move those dogs somewhere else. If you got stinky litter boxes, hey, we got to put the cat with a new friend, or make sure you're cleaning out that litter box on a regular basis. But nothing against, I love animals, but if you're trying to sell a property, it's one of the most important things about, do not let the borrower dictate showing history. Like I said, if you don't get any showing, then you're going to go say, hey, we're not going to do this. We're going to go straight back to a deed in lieu, cash for keys, and then we'll handle the sale. And in that case, I'm going to give the borrower, hey, you're moving out. You've had a month in, and I would tell them this, like, if we don't have an offer in a month, we're going to go back to a deed in lieu. You will need to move out of the property in 2 weeks after that. Okay. So it's important to set that. Now, in some cases, a borrower may just be able to show up with a cash payoff. If they, some of them are going to drag things out, and maybe they don't have a lot of money, but maybe they don't know the options available. Maybe they can go to their friends and family and borrow money. They're not going to be able to go get a new loan from a bank, especially if there's late payments on their credit. But maybe they can go cash in their 401k or an IRA. Those things can take a little bit of time to do, or they can take a loan out against their retirement accounts. That's a possibility to get a cash payoff. You could also do a settlement. If someone wants to stay in a property and it's worth 150, maybe you bought it 100, maybe give the guy or gal a $10,000 break. If you can pay this off at 140 or 150 and do this in 60, 90 days, we'll give you a settlement on it. So those are options you can do: payoff, settlement. Most important things is you got to put the settlement in writing, or the payoff in writing, and put a date when that payoff or that settlement is no longer good. Outline it. Your servicing company can help handle this, or you can write it up, because the last thing you want to do is put no date, and that settlement is basically good in perpetuity. No, you can say, hey, this is only good to the end of the month. Your payoff is good to the end of the month, or it's only good such and such by date. After that date, this payoff is no longer valid. And that's an important thing, because if you have somebody comes back, oh, I want to do that. Well, no, that time is expired. That ship has sailed. It's now cost you more money, because now we've accumulated more costs with servicing and insurance and money costs along the way. So a payoff can happen. You're going to see a higher chance of payoffs on the lower valued assets, but it's not unheard of happening on higher assets as well too for you. Now, of course, let's say you're working through this and you're just striking out. Borrower can't pay. It's in a longer market. Nobody wants to assume the loan. They can't pay you off, can't do a settlement, and you don't necessarily want to go to the legal route of foreclosing. Then here's the thing: if you bought that note cheap enough, sell it to somebody else. If you're in a state that's got a little longer foreclosure time frame, and you want to go through the 6 or 12 or 18 or 2 years, depending on what market it in, sell that note to somebody else. If you can make 5% on a non-performing note deal and do that in 90 days, well, you take that times 3, you technically made a 15% cash and cash return. If you can make a 10% profit in 90 days, guess what? 10% in 90 days times 4, that's a 40% profit. Okay. So the numbers on that, I'm sorry, 5 times 4 would be 20, not 15. Sorry. So that's one way to think about it. And this is what you see a lot of funds do, is they're buying in bulk. They immediately start reaching out to the non-performing borrowers. They give them their time frame. They give them 30 days to come to the table. If they don't come to the table in 30 days, then they're looking to offload that at a 10, 20, or 30% market. Whatever they can get from individual note investors will come in and buy that note, because that's still a great annualized ROI in the long run for their fund. They get their capital back in, they make some profits, and they can put that money back in to buy more assets. The borrowers that want to stay, great, they become reperforming notes. That looks good for the portfolio. And that's really what you see with note funds, is it's going to be buying non-performing to get them reperforming. Those that don't reperform, they start to go on the liquidation pile in 90 to 120 days, so they can still make good money. Now, if you don't want to sell the note and you're okay with the borrower not paying you, well, nobody's okay with that. but you're okay for the long haul because you bought cheap enough, guess what? Foreclosure is the next option. And each state has a different foreclosure time frame. It's as fast as 21 days here in Texas, all the way up taking 3 years in New York or Puerto Rico out there. You have judicial, non-judicial foreclosures. Non-judicial foreclosures are like Texas, Georgia, Virginia, North Carolina, Missouri. Judicial foreclosures would be like Florida, Illinois, New York, New Jersey. Those are much longer time frames, and it can cost you anywhere from like $750 to foreclose, say in Harris County, Texas, all the way up to like 10 grand or more in New York. So keep that in mind. Foreclosure happens. There's a time frame. You just got to talk to an attorney and start going that route. And I would immediately, if you can't get a bar doing something in the first, if you don't get any response in the first 30 days, send it to an attorney. If you start getting a response back and forth and you're working through, that's right. Give the bar an opportunity to come to the table, do something and see, but they don't fall through, kick it to the attorney and let them deal with the attorney. You can always stop the foreclosure or suspend the foreclosure while the borrower is working out, as long as they're following through on the process. Now, of course, if they're in trial payment plan or a mod, you want to definitely stop that foreclosure, suspend it for at least 6 months to make sure that your borrower is going through, but don't stop the foreclosure, just suspend it. And then if they start making 6 on-timents, then you can stop the foreclosure, because you can always start it back up again and go from there. All right. Now, let's recap those really fast. Wholesaling, reinstatement, loan mod, or trial payment plan, loan assumption, doing a deed in lieu of cash for keys, doing a short sale, a property sale, getting a cash payoff or settlement a little bit, selling the notes if you don't want to go through the work, going through the foreclosure. That leads us to 2 other strategies here. So we mentioned earlier that the first idea is to take a non-performing note and get it back on track, right? Well, that gets back on track for 12 months is now considered an on-time or performing note or reperforming. You can now resell or sell that reperforming note back to the market. There's plenty of note investors out there that are buying reperforming notes. I'm one of those guys. If I can get a double-digit return, 12 or higher, I'm definitely interested. There are funds, banks, institutions, hedge funds that are looking for reperforming paper. If they can get an 8 to 10% ROI, that you're looking pretty good. So if you bought a note at 50 cents and you can now sell it at 85, 90 cents after a year of on-time payments and some extra skin in the game, it's a pretty good ROI to you too. So that's a true win-win across the board. That's not going to adjust the terms of the loan or the loan modification. Just make sure that your loan modification, you're selling it based on the terms of the loan mod, not the extra per month or anything like that. Okay. And then last but not least is something that happens a lot of times. If you're going to the foreclosure process, a borrower will file bankruptcy the day of or try to avoid a foreclosure. And that'll happen, especially as the higher up value assets you get. Bankruptcy is going to fall of 1 of 2 categories. It's going to be either a BK Chapter 13 is what they all have to file first. And that is they'll have to submit a BK workout plan. And that's basically a 9-page PACER report, shows everything they owe, what they plan. They submit a payment plan, which would be basically a 5-year loan mod. Now, if they don't fall through on that plan or the plan doesn't make sense, you can always kick that plan out and say, no, judge, this doesn't make any sense. A normal mortgage payment's $800. They want $50 a month. That's not going to work. It's got to make logical sense. You just got to hire an attorney, or your servicing company can help provide an attorney for you, find an attorney that represents you in the bankruptcy court. Now, of course, if they can't qualify for BK Chapter 13, it may be a BK Chapter 7, which is a liquidation of debt, which means they don't, with credit cards that they write up, doesn't mean they just forgive the debt on the house. They basically have to turn the house over that point and move out. So they don't get to keep the house. All right. They've got to sell the house off. Now, of course, bankruptcies too. Some people will file bankruptcy because of medical bills or credit cards. If they're on time with their mortgage, they don't have to file bankruptcy and put the mortgage in there. They keep making the existing mortgage payment on time. So there are some creative bankruptcy defaults to help them, like I said, with medical bills or credit card debt, stuff like that for you. But BKs are not bad. BK Chapter 13s, there's a lot of funds that like those. They're considered a premium because they've got a payment plan. Now, if you get one of those, that's a great day for the most part. If they stop paying, like I said, you can have the bankruptcy discharge and finish the foreclosure and go that route. But once again, those are really the 11 extra strategies. Once you foreclose or take a property back, I don't care what you do with it. That's your choice. All right. You can sell the property, you can keep the property, you can owner finance it. I would not do a lease back. I've had people in the past, I'm going to lease it back to the borrower. That is a bad idea. If they couldn't pay a mortgage payment, which is going to be cheaper than market rent, they're sure as hell not going to be able to pay rent. So don't lease it back to that same individual. That's just asking for a lot of bad luck, to do that. So evict, get the borrower out, and then either sell the asset off, which is my favorite strategy. Doing an owner finance thing into it, your ROI is going to be good. If you want to turn in a rental, hey, you're in the note business, not the rental business. That's creating another whole job for you as well. But that's up to you. Maybe it's an asset in a state or area that you like, and that's fine. Add it to your portfolio on that aspect. But I'm a big fan of getting that capital in and then going back and rebound, doubling down as I can. So those are roughly the 11 exit strategies. Once again, big quick recap: wholesaling, reinstatement, getting back on track. Third is doing a trial payment plan to a loan modification. 4, a loan assumption. 5, deed in lieu or cash or keys. 6 is a short sale. 7 is getting a payoff or a cash settlement. 8 is reselling the note, a non-performing, to another note investor, let them take it over. 9 is foreclosing. 10 is reselling the performing note with 12 months of payments. And then 11 is if the borrower files bankruptcy, it can either be a loan mod, BK 13, or taking the property back in a BK Chapter 7. So cover all these things a lot more in depth. And like I said, our 3-day virtual note buying workshop, you can get signed up today at notebuyingfordummies.com. We cover a lot in 3 days. This is just a drop in the bucket from the last 3 episodes. I'd love to have you take a part and join us in that class. If you can't make it live, don't worry, the replays are included, and we'll kick you to the next live class that you can attend as well. But go out, take some action, everybody, and